Hello and welcome to this Tomra webcast here from Arctic Securities in Vika. Today we will be going through our recent research report on the company, where we reinitiate coverage with a sell recommendation and target price of 250 NOK per share. Through the presentation, it will be possible to ask any potential questions through the Q&A function on the right hand of your screens. So then I will leave the word to my colleague Christian, who will take us through the presentation.
Thank you. So we reinitiated the coverage with the sell rating, and we think it might be a good timing now, as the share is up 50% year to date, in light of the current market environment regarding the pandemic and the macro uncertainties, which can push the new deposit markets further back and give negative growth in the sorting segment. And we have 5 triggers or reasons why you should short Tomra now. But first, we're just going to put a little bit in perspective here. So Tomra is today trading above all the Famang stocks. And if you look to the bottom right side here, you see that even adjusting for earnings growth, it screens even worse. And especially if you take the new markets estimate of new deposit markets in the UK out of the 2023 estimates. And some say that Tomra has always been an expensive stock, but if we try to just look simple on it and turn around on this schoolbook valuation formula, we see that back in 2017, 30% of the share price was explained by future growth opportunities. Then Arctic had an EPS CAGR of 12%, and 9 out of 10 analysts had a hold or a sell rating. Today, 81% of the share price is explained by future growth opportunities, while we have a 9% EPS CAGR, and 9 out of 10 analysts have a buy or hold recommendation. The first trigger we see is that you have declining growth outlook in the sorting segment as FX tailwinds fade off. Actually, you had negative organic growth in 3 of the last 4 quarters. And if you look at an average book-to-bill of 1 in the last 2 years, it illustrates the low activity you had in this segment. And this segment is primarily driven by the food business stream, which is 64% of the sales. And here, the customers are increasing their capex by 0.5% yearly. And when Tomra then expects this market to grow about 6 to 8%, it implies that sorting machines is an increasing priority among its customers. And especially in the US and European market here, where you see the lowest growth. If you look at the recycling segment, the customers there in the middle chart, you see that capex is increasing by a 10% CAGR. The long-term outlook here is stronger, but we emphasize that it's cyclical, as customers has a large dependency on commodity prices. This is also true for the mining segment, albeit small. Capex in 2020 is expected down 20% in 2020. And we also see new market entries in collection solutions being pushed as another trigger. There's a big hype around the whole EU to implement deposit systems by 2029, as the US set a 90% collection target. Today, you only have these countries which are actually talking about it on a higher level. But if we look back on it, because this is a long process where you have to design the scheme, and if you look back at Scotland and the rest of UK, this has been pushed 2 and 3.5 years respectively, as of what was expected in the second half of 2018. And we are not surprised if these are pushed even further, especially now with the current pandemic, as new deposit markets are probably not highest on the agenda. And we also think that the position in these potential markets, these potential new markets, could disappoint. So to my understanding, most analysts are modeling and doing valuation on new markets with the Germany example, which is what we have most data on. But in the 3 recent markets that Tomra has entered in 3 states in Australia, this is actually the outcome of Tomra RVMs per million capita. And in New South Wales, you actually got a sole operator role, while in Western Australia, the scheme was designed such that non-for-profit organizations and schools and community groups can apply for grants to help them establish manual refund points for beverage containers. And Tomra simply doesn't see it as economically making sense to enter this market that hard, and it will only operate about 5 of the 150 refund points in the state. So we see downside to some markets becoming more like this, especially when the expectations are like the German example. We think there's downside risk on this. And we also think that the EBITA margin will fall short of the 18% target. Primarily where you need a margin expansion is in the food segment within sorting solutions. So over the last decade, increased exposure to the more competitive food sorting market mostly through acquisitions had weighed on the margins in sorting. And if you look back on it, the margin in sorting when you only had recycling and mining was about 20%. So this implies about a 10% margin in food. And this is in the high-end range of what we can find on peers here on the right-hand side. So we find it difficult to argue for any margin expansion, as you're already in the high-end range in food, which is an established market, more mature market, and already have above 20% margin in recycling and mining. And especially considering that Tomra also plans to enter the mid-market, because this is where you see growth in typically emerging countries. And here you would most likely meet more price-sensitive customers. So lastly, we see consensus estimates sliding. We have simply just assumed on the top line in sorting that you have an 8.6% year-on-year organic growth, which is the implied market growth rate from Tomra's expectations. So you can see that consensus is above this, and 8.6% is also above the 8% organic CAGR historically, which you have delivered. And in EBITA, in the sorting segment, we also expect flat margins roughly, and we're already 10% below consensus 2021 EBITA in sorting based on this. So we think that consensus estimates will come further down. They've already down 28% and 30% for 2020 and 2021 EBITs, if you measure this in euros. And we think one of the big triggers here could be, if you look at the bottom right chart here, Tomra has grown their revenues by 11% CAGR since 2015, but most of it is actually acquired or FX. So we think that if you just look at the big picture here, if you start to deliver 5% growth instead of maybe if you deliver 5% growth, and then you will also get FX headwinds in the first half of 2021, we think that this can be the first kind of trigger. You see the top line coming down, the growth rate coming down, then you start looking at the margins. You see they're not improving. Then you see free cash flow is the same as in 2015-16, and that free cash flow margin has dropped from 10 to 6%. And if you also look at valuation, you have all-time high multiples. You once used to trade in line with this Nordic peer or industrial quality company peer group, but you have detached from them significantly in the last few years. And these are companies that they're bigger than Tomra for one, and they have good growth and they have high returns on capital. So you used to trade in line with these on EV/EBITDA for in 2015 to 18, and now you're trading at a 100% premium, despite having the same earnings growth expectations. We are below consensus on that, and also you're delivering a below average return on capital. And if we do some scenarios on this, let's say that Tomra delivers on their financial targets and has a 12% revenue CAGR. You put a 20% EBITDA margin on that, and you put a 20% premium to an over the cycle EV/EBITDA, then you derive a fair value of 366 per share. And so if you're on the long side here, you still have to see a 100% valuation premium to see some further upside. And to kind of get a feel for what's priced in today in the market, if you take a DCF on the sorting solution to 2035, 10.5% CAGR growth, a yearly margin expansion, and we assume that the whole EU implements a deposit system where Tomra gets a 70% market share, we derive a fair value of 414 NOK per share, and it would imply about 18 EV/EBITDA in 2030, and we find that valuation very stretched, considering that this is like a blue sky scenario. And for our valuation, we done a sum of the parts. If you first look at the current operations, we apply a 20% premium on sorting solutions compared to peers, although peers have higher short-term expected growth, higher returns on capital. We see that the long-term outlook is very strong. On collection solutions, you usually just put a free cash flow yield on it because these are steady earnings or at 20 EV/EBIT. And then you derive a fair value of 194 NOK per share for the current business. And then you can start to play around with potential new deposit markets. Usually we risk this, and with our risking, we come to a fair value of 250. If you unrisk all these markets, we come to 289. So from current share price, there's about the 40% downside to our target price. I think that's about it. Do we have some questions?
Yeah, so we have received some questions here on what sort of pushback we have received from investors who are positive to the share. And obviously one thing that's been repeated several times the last couple of days is how attractive they find Tomra's market position and how positive the growth outlook for the industry remains. However, I think we have timed it well when it comes to having a look at what's actually priced in, even as you mentioned, when we look all the way ahead to 2030 and put in sort of highly positive assumptions as well. In addition, I think we would argue once again that the current share price does not reflect an organic growth rate of 5% going forward. We once again would like to highlight that we expect EBITA margins to fall short of the 18% target, and we think that in a business environment where FX tailwind levels out the next couple of years and potentially could also temporarily have a negative impact, we think that what you're left with is an all-time high valuation multiple and also a vulnerable share price, and trading at roughly 90 times our estimated earnings next year, we still see significant downside from current share price levels. So I think that pretty much summarizes our view. We are, of course, happy to answer any questions you may have, either by telephone or email. Thank you for listening in, and have a nice day.